Global markets are shifting in ways most retail investors aren't fully paying attention to yet. While headlines continue to focus on mega-cap tech stocks and short-term volatility, smart money is quietly positioning itself in sectors that are undervalued, overlooked, and structurally positioned for long-term growth. Today, we're breaking down the top 7 underrated sectors that could outperform across the United States, the United Kingdom, and Canadian markets in the coming cycle. Let's start with industrial automation and advanced manufacturing. In the US, companies aligned with reshoring initiatives and supply chain resilience are benefiting from federal incentives under policies like the CHIPS and Science Act. Meanwhile, the UK and Canada are investing heavily in modernizing infrastructure and domestic production capacity. As global supply chains fragment and nations prioritize self-sufficiency, automation providers, robotics firms, and precision manufacturing companies could see steady, long-term demand growth that isn't yet fully priced in. Next is energy infrastructure. Not traditional oil speculation, but the backbone systems supporting energy transition. In the US, grid modernization is accelerating alongside renewable expansion. The UK continues investing in offshore wind and grid reliability, while Canada remains a critical energy exporter. Policies like the Inflation Reduction Act are driving billions into clean energy credits and infrastructure upgrades. Transmission lines, battery storage systems, and pipeline operators may quietly deliver stable cash flows and dividend potential, while the market focuses on high volatility growth names. The third sector flying under the radar is defense and cybersecurity. Geopolitical tensions have fundamentally reshaped government spending priorities. The US continues allocating significant defense budgets. The UK maintains NATO commitments, and Canada is increasing modernization spending. Firms tied to aerospace systems, defense technology, and cyber protection services stand to benefit from multi-year government contracts. Unlike consumer-driven sectors, defense spending tends to remain resilient regardless of economic slowdowns. Healthcare equipment and medical technology is another sector with strong structural tailwinds. Aging populations in the US, UK, and Canada are driving sustained demand for diagnostics, surgical devices, and advanced treatment technologies. Unlike speculative biotech plays, established medical device manufacturers often produce consistent earnings growth and strong margins. As healthcare systems modernize and prioritize efficiency, companies providing innovative but practical medical solutions may outperform broader indices. Fifth on our list is critical minerals and materials. The transition toward electric vehicles, renewable energy storage, and advanced electronics requires lithium, copper, nickel, and rare earth elements. Canada, in particular, holds strategic mineral reserves that are becoming geopolitically important. As governments seek to secure domestic supply chains, mining and materials companies positioned in politically stable regions may see rising institutional interest. This sector remains cyclical, but long-term structural demand is strengthening. The sixth underrated sector is financial infrastructure and asset servicing. While traditional banks face margin pressure during rate transitions, companies that provide payment processing, clearing services, and investment infrastructure often benefit from market volatility and cross-border capital flows. The US, UK, and Canadian markets each have unique strengths, but these 7 sectors represent a shared structural shift across developed economies. As always, diversification and disciplined risk management remain key, but understanding where smart money is positioning itself can provide an important edge. The next outperforming sectors may already be building momentum just outside the spotlight.